As DBS has said, it's probably going to be difficult for the momentum to continue into 2025. They have talked about the global minimum tax, and they've said that net interest income should be slightly up thanks to better loan growth. They are forecasting 2 rate cuts towards the second half of the year. That might be a little optimistic. But long and short, they have done exceptionally well this year. It's in 2024 rather. And a lot of that has come through fantastic growth in the wealth franchise. The wealth franchise really powering on all fronts. The challenge that we see for 2025 is that you're probably going to see a lot of volatility in markets. We have seen already that given the number of guidances and directions that are coming out of the US administration every day, that everyone is watching on the sidelines. We do anticipate that the corporate world will take a step back and really try to understand what various movements mean for them. So loan growth, I think, might be a little bit more challenging. I also anticipate that wealth management, it was very strong FY24. So FY25 will be more difficult. But on other fronts, whether it's cards, whether it's bank assurance, whether it's treasury income, they should do well. But 25 definitely a more challenging year than 24.
Indeed, and when you look at the markets, markets income, at least for DBS, it was one of the sore spots which actually declined. But they've done a very successful pivot into wealth management, into fee income. Is that going to be enough to actually keep them afloat and keep them, fairly stable, especially when you compare it to the highs that they've hit in 2024?
So they've done a fantastic job so far, and if you just think of share price on a year-on-year basis, I'm a credit analyst, but we obviously do look at where the equity is trading. It's up 50%, right, on a year-on-year basis, whereas the other Singapore banks are up a third. So if you were to take that into account, that's already a little bit in the share price, but that is thanks to the very strong performance that they've had so far. Stock markets are likely to be challenging over the next year. Over 2025. So I think maintaining this current level will be a good outcome for DBS.
And what about maintaining the level of divs, if not improving or increasing them? Because that's one of the main reasons why a lot of foreign investors have exposure to buy Singapore banks.
So the dividend side of things, I think they've done a very good job in terms of forward guidance to the market in terms of what this year is going to look like. There is a bump up that they've had in capital as a result of the new Basel III, the regime that's coming in. There's a transitional role play, and so their capital ratios have come up. They've said that they're going to dividend some of that out. They don't really need all of that kind of capital for the next couple of years. So that's good. Now, what they have done very well, and full credit management, and it's interesting, this is Mr. Gupta's last set of earnings, is in terms of what everyone wants is a certain degree of predictability and stability, and for fee income to constantly be growing, and all of those levers have been put on. So, so far so good, and let's hope that there's more of the same.